Hey everybody, and welcome back to another episode of Thanks for That. We just saw Bitcoin hit a new all-time high of 50,000 US dollars, and I'm looking back at my second episode on this channel 5 or 6 weeks ago, about 5.5 weeks ago, when I made the episode about cryptocurrency and explained what it is and how you can get into it. And I'm wondering if any of you out there actually decided to buy some at that time because it had just made its new all-time high at that time of $20,000. And now sitting at $50,000, you would have made a pretty nice profit.
Oh my God! Wow!
So leave a comment down below if you did buy it, and also leave a comment down below if you didn't buy it, because I'm pretty curious why some people still don't want to buy it. So leave a comment, let me know why you did or why you didn't, and maybe we can talk about it down in the comments and maybe teach each other a few things about why people don't still want to buy it, because obviously I do buy it and I'm always curious why people hold back from buying it. Looking back about 6 weeks ago, it was sitting around 18,000, 19,000 US dollars. And obviously now at about 49,000 US dollars, most people would do anything to buy at $40,000, which is obviously double what it was 6 weeks ago when it was around 19,000. Everyone thought it was too expensive then. Now people wish they could buy it at double that price, and sitting around $49,000. I'm curious if anyone is buying now or if they're waiting for it to go back down to the $40,000 mark or $45,000. I just had a friend say that they got lucky and bought Bitcoin at 47,000 in a short dip. Crazy to think that $47,000 Bitcoin is really cheap, but maybe in a few months from now we'll be thinking 50,000 was a steal. So it's interesting to see where it's going and where it came from just a short period of time ago. So yeah, leave a comment down below and let me know if you did buy it, and if you're selling now, taking some profits, or if you're waiting until it gets to 100,000, or if you're just going to hold forever because you think it is the future of currency. So let me know why you didn't buy it at 20,000 when I made the video 6 weeks ago, or five or 6 weeks ago. And let me know if you bought since, and maybe what price you did buy it at. And if you're dollar cost averaging, that's a good idea to do that, like I said in the video, to give yourself a nice average base. But yeah, really curious about what people think with Bitcoin and cryptocurrency. So leave a comment down below, and now let's get started with today's video explaining initial public offerings, also called IPOs. So let's get started. So a couple weeks ago, somebody asked me about how IPOs work because a few of their coworkers were talking about the upcoming Bumble IPO and how it was going to be this huge thing and they should all get on board. So I explained how it worked, and she was really curious and interested and said that I should make a video. And here we are now, where I'm making this video explaining to all of you how IPOs work. So basically, an IPO is when the owner or owners of a private company or small business finally get to cash in and get rich. And if you haven't seen Wolf of Wall Street yet, it's a really good movie and I suggest watching it, but it kind of shows how a smaller startup company like Steve Madden ends up growing to the size where they go public, and that process behind the scenes in an investment bank and a big investment company, how they take a small company into an initial public offering and make it publicly traded on the stock exchange.
I want you to go out there and I want you to ram Steve Madden stock down your clients' throats till they fucking choke on it. Yeah. Till they choke on it and they buy 100,000 shares. That's what I want you to do. You be ferocious. You be relentless.
So, as I said, the owners don't really make a lot of money until that period of time. In the beginning, all of the profits that the company makes usually gets put back into the company, which is how companies grow so fast. And that's why you often see owners of businesses not driving fancy cars or having a lot of fancy things, because everything they make goes back into their company. I'll use one of my really good friends as an example of this because about 10, 11 years ago, he became an entrepreneur and started his own company, a small tech company where they sold and installed smart home features and home theater type features. And about that time, I was still pretty immature and not very good with my money, and I had actually just bought a brand new F 150 with cash, which was one of the dumbest decisions I ever made. And I remember hanging out with my friend one day and I saw that he had a cracked phone screen. And I was bugging him, why doesn't he get a new phone? And or fix the screen, and he said, if I go spend $200 to fix the screen, then that's 200 less dollars that I get to put into my company and invest in that and help it grow. And I didn't really understand it at the time, but he was much more disciplined with money than I was, and now that company has grown into a rather large company, and he has I think 14 or 15 employees underneath him, and he does multi-million dollar jobs where he sets up homes in Vancouver with unbelievable tech in their smart home where everything is automated, hidden speakers in the floors and the walls. It's pretty amazing what he can do, and he's done such a good job. So shout out to his company. It's called Pure Image. He doesn't know that I'm doing this, but yeah, I really admire what he did with that company, and it just shows what it takes to grow a company to that much success, because yeah, he would put everything he had back into that company rather than taking those profits and living like a baller temporarily. So, when a small business owner gets to start driving around in a Ferrari or Lamborghini is when their company goes public and they have an initial public offering. That's because in the beginning, they don't really make a lot of money, even when they sell parts of their company for more investment money. It always goes back into the money. So let's just use a big example so that you can kind of picture it in your head. So here's the life cycle of a company. It becomes a startup, either by one person or a couple people with usually a small amount of seed money. So let's say I'm starting my own company. I put in $10,000 and try to just get it off the ground. So obviously, starting a company, you burn through $10,000 really quickly, and now I need some more money to keep the company growing, but I don't have any savings, so I go to, let's say, my bank and ask for a small business loan, but because they don't have a high risk tolerance, they decide to decline me. I end up convincing one of my friends that my company is really good, and he becomes really excited about it, and he puts in $20,000 and wants, let's say, a certain percentage of the company. So, after looking at all of the financials and where the company has come so far and where it could be in the next few years, we decide that his $20,000 is worth 25% of my company. We agree on that, and let's just say that there's 100 shares of the company. I have 75 shares now, and he has 25 shares. Also, remember, in another video, I explained that shares are just like stocks. Anyway, he put in $20,000 and got 25% of my company, which values my company at $80,000. We came to that in evaluation. Now, we came to that evaluation, like I said, by looking at all the financials and so many other different factors. And I won't get into how to value a company because it's very technical and takes a long time to learn. And that's pretty much what investment school is all about. Now, when he gives me that 20 grand, I don't just put it in my pocket or go buy a car or a watch. I put that 20 grand into my company and help it grow because, as they say, it takes money to make money. So here I am. I still have no money, but I've got 75% of an $80,000 company. And hopefully, with that $20,000, we can grow that company into a much larger valuation. And then I would own 75% of a large company. So we end up growing the company pretty large and reinvesting all of our profits, and realize we actually need a large sum of money to really get this company to take off. So of course this is all fictional, but let's just say we go on to Shark Tank. And I'll use Shark Tank because of course you have all seen that show and you know what goes on and the different arguments or discussions that are done on the show trying to determine the company's value. So by the time we get on the show, we have grown like crazy and we try to argue that the company is worth $800,000. So my partner and I have discussed that we will each give up 10% of our company, which means that we will ask $160,000 to make that $800,000 valuation. Now, one of the sharks decides he does want to get into the company with us, and he thinks that the valuation is just a little bit too high because, of course, he's not just bringing money, he's bringing his expertise. So he offers the $160,000 that we need, but he wants 30% of the company. My partner and I decide that yes, it would be great to have a shark on board, so we will each give up another 5%, bringing it at 15% each and making it the 30% that the shark wants, and the deal gets done. So, of course, that makes the valuation of the company $533,000 because we just sold 30% of it for $160,000. Now, let's just say the next few years go very well, and with the shark on board, our sales end up exploding and our company grows to amounts that we could not even imagine. Now we all decide, after looking at all the financials, that our company is worth $20 million. And of course, I still own 60% of that company, with my friend owning 10% and the shark owning 30%. Now, even though my friend and I own a significant portion of a multi-million-dollar company, we still don't feel rich. Our bank accounts are less than six figures. We drive beater cars and live in small, modest homes that we keep having to do home repairs on, and we ask the shark if we can take out some money and start living that rich entrepreneur lifestyle. So the shark explains that now is a good time for us to take our company public and we can all sell off a portion of our shares and get rich. Now, most of the time when a company goes public, they are worth a lot more than $20 million, but let's just say that for this example, to keep things simple, now's the time we go public. So the shark, being an expert in this field, ends up talking to some contacts at some big investment banks, and we all agree on a magic number of what the company is worth. Of course, we think 20 million, they think less, and we argue to get to a certain number. So after some good negotiations, we all agree to sell half of our shares to the investment bank, and they agree to pay $9 million for that, which means the valuation of the company is $18 million. Of course, they need to come in at a lower offer because they are providing a service, so we may think that the company is worth $20 million, but we're willing to sell half of it for $9 million because the bank is providing the service of taking our company public. This is the time where we as owners finally get to take some money and put it into our pockets and start living that lavish lifestyle. So we each sell half of our shares, leaving me with 30%, my friend with 5%, and the shark with 15%. And for that, we all made some good money. I made 5.4 million, my friend made 900,000, and the shark made 2.7 million. Not bad if you can remember how much money we all put in the first place, and the bank is happy because they just got a little bit of a discount on a $20 million company, and then when they sell the shares to the public, they're going to make even more money on top of that. So, of course, if we only had 100 shares in our company, we need to do a massive stock split, which takes all of our shares or stocks and splits them up into multiple shares, giving us the same amount of value but within more shares. If you want to think of it in simple terms, it would be like having a $100 bill and splitting it up into 10 $10 bills. You still have the same amount of value, but you have more bills. So let's just say we split the company up into 20 million stocks or shares, which would give each share a valuation of $1. Now, of course, I still have 30%. We all still have the same amount of percentage. The bank has 50% of the shares. Our value hasn't changed, but the amount of shares has obviously gone up. So now, of course, the bank gets to take their half of the shares and sell them to the public, giving everyone a chance to get a little tiny piece of our huge, great company. But of course, when this happens, the bank gets to decide the price. So let's just say the bank wants to make an immediate profit and they decide to start the price at $2 per share. Now, of course, that's just an example, and the investment bank doesn't always just double the price of shares right away. Now, let's just say that my company has a lot of hype around it, just like Facebook stock did when it went public. So everybody at work, your bartender, your taxi driver, people on the bus, everybody seems to be talking about this company going public and how it's going to be so great, and they all want to get on board. So I'll just do a really quick imagination explanation of the stock market, because a lot of people find that when I explain it this way, they can picture it in their head, and it makes them understand the stock market and the order books, one side being the buys and one side being the sells. So when we talk about the market and order books, think of a big warehouse with buyers on the left and sellers on the right, and they're forming giant lines or queues, and the person at the front is the one bidding or asking the best price. So, of course, on the buyer's side, the person at the front would be the person offering to buy at the highest price, and on the seller's side, the person at the front of the line would be the person offering at the lowest price. The gap in the middle of those two people would be called the spread. Now, of course, people change their price constantly. So let's say someone at the front of the line is offering $1 per share. That person second in line is only offering 99 cents per share. But let's say they actually want that stock pretty badly. They might jump in front of the person in line and offer $1.01 per share. Same with on the other side, if somebody is offering to sell at $1.10, they might think, you know what, I just want to sell and I don't need to get $1.11, so they jump in front of that person and they offer $1.09 to sell. And of course, it just keeps getting closer until someone from the left side offers to buy from someone on the right side, and they meet in the middle, and that is where you find the market price. So let's just put a picture in our heads that at this marketplace, people are buying and selling potatoes, and they're trying to argue about price. And of course, some people think that they won't buy potatoes for any more than $1. And some people think they won't sell potatoes for any less than $1.50. And then there's a whole bunch of people in between, and that is where the market moves up and down in price so fast. So let's just say that somebody hears that all the farms have way too many potatoes and that there's going to be a bunch of potatoes available. So they want to sell their potatoes as fast as they can before the market gets saturated, and they start running across the spread in the middle and start selling their potatoes to any buyer that they can find for any decent price they can get. Of course, that brings the market price down in quite a hurry because people start selling potatoes for less than $1. And just a few moments ago, potatoes were selling for $1.10 to $1.20. Then some news comes out that the farms that have all those extra potatoes actually got this plague of pests that have ruined the potatoes, and there's going to be way less potatoes in the market than any year previous. So, of course, now nobody wants to sell their potatoes. So now people are frantically trying to buy any potatoes IPO that they can get their hands on, and people are canceling the for sale orders and taking down their for sale signs of $1.50, $1.60, and re-putting up for sale signs for $1.90 or $2, and the buyers are still running towards them with money in their hand, and the price is driving up, and that's how prices can move so high and so low in such a short period of time, because it's all about market sentiment and any rumors that could adjust the price one way or the other. So getting back to our example, we're actually going to use GoPro in place of my small company, because this actually happened to GoPro, and it's going to be the perfect example of why you need to be wary of hyped up IPOs. So GoPro's initial public offering price per share was around $42 per share. And if we talk about our example where we all agreed with the investment bank that the price was about half that, that would put the original price at $21 per share, and the investment bank just doubled that to put it out on the public at $42 per share. And of course, with all the hype around GoPro, there was so much demand and people just fighting to try to get some GoPro shares that the price went up exponentially in just a matter of days. So because of all the hype and buzz, the price actually shot up more than double to $95 per share. And remember, this actually happened. And now we know that when the initial public offering comes out, it's actually at a higher valuation than what the investment bank and the owners of the company just agreed on after their in-depth analysis of the company's value. So as soon as it hits the market, you already know that it's likely a little overvalued, and then if it doubles or more than doubles in the case of GoPro, then the company is obviously way overvalued due to its hype. So unfortunately, there were still people buying in the $90 to $95 range because they didn't think about the valuation of the company. So now mixing this real life example of GoPro with the example of my company, let's just pretend I'm the original founder of GoPro and I still have all those shares sitting there. Just weeks ago, I sold half of my shares at the valuation of $21, and then we went public at $42, and now the price per share is sitting at $95. So what do you think I would be thinking when I'm sitting there with all those shares and they're going for $95 each? Now, if you said sell it all, that would be true, except that this is my company, it's my baby, I've put my blood, sweat, and tears and haven't gotten any sleep for the last 10 years of growing this company. But the shark, on the other hand, is merely an investor, and he really doesn't have an emotional connection to this company. And remember, he's holding 15% of the shares. Now, since we did a stock split of 20 million shares, that is a lot of shares, and he decides, wow, at this price I need to just cash out, and he dumps all of his shares onto the market, which of course drives the price down. So if we go back to our imaginary stock market of buyers on one side, sellers on the other side in this giant warehouse with the spread in the middle of where they're trying to find that equal number of price, right now, the last price of the stock was $95 per share. That doesn't mean that you can sell all your shares for $95, however, because let's just say the person at the front of the buyer's line is offering $95 a share, but he only wants to buy 1 or 2 shares, and then the person behind him wants to buy 10 shares, but they're only offering $92 per share, and so on down the line. So you can't just sell all your shares at the price that it's showing, which is $95, because that is just the price of the last share sold or bought. So let's just say the shark walks into the warehouse, they go running across to the lineup of buyers, and they literally take their 15% and throw it all the way down the line to everyone who is currently offering any price, and it takes the price from the person at the front offering $95 all the way down to everyone offering $90, $80, $70, $60, $40, and it drove the price for real in GoPro. It drove the price from $95 down to $40. And remember, that's what the share price started at, around $40. And that happened so fast. And then, of course, everyone was thinking, oh, you know what? It was just one of the big investors taking out their investment and dumping their shares. But this company still has so much hype. So everyone thought, let's buy the dip. And that one person just dumped all their shares, or that investment group just dumped all their shares, but the company's still so great. So people started buying up as fast as they could because the price was just $95 and now it's $40. So they think it's such a steal. They buy, drives the price up to $65. This actually happened with GoPro, remember? It went from around 40 to 95, back down to 40, up to 65. And then once it got to 65, let's just say my friend and I, also huge shareholders, decide, well, you know what? This is probably a good time because while we know the company is only valued around $20 to $25 per share, the shark already dumped all his shares and he's obviously a professional investor. And now that it's around $65 a share, I think that it is really overvalued. So let's sell some of ours. So my friend decides to sell all his shares and he's out of the company. Me, of course, being the owner and founder of the company, I only sell half my shares, but that is still a large amount of shares being dumped onto the market again. So all those buyers, again, picture in the warehouse, all these people trying to buy the stock, we go to them and just boom, dump all of our stock onto those buyers again, driving the price down even further. So because we dumped all of our shares onto the market, that actually made the price go all the way down to $12 per share. And now we're talking about a real company here, GoPro, and this actually happened, and the time frame that it happened was all in less than 1 year. So in 1 year of the initial public offering, the price went from 40 to 95, down to 40, up to 65, and down to 12, all within 1 year. Obviously, the shark made a killing on his investment. My friend and I are also just ridiculously rich off of our starting this company, and anybody that bought with all the hype has now lost a large portion of their initial investment, especially those people that bought in the $90 to $95 range. They have now lost about 90% of their money. So the moral of that is to do some due diligence and look at what the company should be valued at, and not just FOMO, which stands for fear of missing out. Don't just FOMO into a stock because everyone at work is talking about it, unless of course you work at a financial institution where people are really good at valuations and know about investments. But if not, then be very careful and don't just listen to your taxi driver when he says you should get in on this IPO. There is actually a really famous quote which I love from an investor called Peter Lynch, and it goes like this: "It bothers me that people are very careful with their money. The public, when they buy a refrigerator, they go to Consumer Reports. When they buy a microwave oven, they do that as well. They ask people, what's the best kind of radar detector or the best kind of car to buy? They do all their research. And when they go on a trip, they get one of those little mobile guides or a Michelin guide when they're traveling Europe. But they hear a tip on a bus on some stock they've never heard of, and they'll put half their life savings into it before the sunset. And then they wonder why they lose all their money in the stock market." So the moral of that is that we all seem to do research when doing different things, whether it's buying a phone or buying headphones or, of course, going on a trip. But when it comes to the stock market, we take advice from our taxi driver or some coworker at work, or what's worse, even somebody on the bus that we overhear a few seats behind us and we don't even know. So that is why you should always do your own research and not just listen to anyone that shills any sort of stock, especially when it's a hyped up stock that's coming as an IPO. Now, if you're wondering what happened to the GoPro stock in the past 5 years, it has fluctuated between $10 and $14, and it has not gone up since that initial crash from 95 to 40 down to, or up to 65, and then back down to 12. So if you did buy at the 65 range when it went to the second spike, or God forbid, the $95 range when it hit that first spike, you have still been sitting there holding a bag at $12 per share. Of course, there are plenty of stocks that are sitting at a higher price than their initial public offering, but you just have to be careful when there's a lot of hype around something, because that is when the price can get pushed up way beyond its real valuation. Hopefully that helped you understand IPOs and also the stock market in general with regards to the buyers and sellers on each side of that order book and the spread in the middle, and how that stock price gets to come where it's at. And remember that the stock price isn't what you can sell all of your shares for, because that is just the price that the last share was sold, and there might not actually be anyone willing to pay that exact price. So you have to look at the order books, which are on the stock exchanges, and you can see how many shares are being offered at what price. Now that it is so easy to do your own investing with all of the new apps and websites out there, a lot of people are doing their own investing, and that's why I think these videos are very useful to learn about how to do it so you don't get burned. Next video, I will be doing a viewer's request of teaching how to use stop losses and what they are, and limit orders rather than just buying at the market price. And if you have any other questions, please comment down below, because I'm happy to explain anything and everything. So make sure you hit the subscribe button so you don't miss any of these educational videos, and please also hit that thumbs up button down there, because it really helps my channel grow, and lately I've been getting about 10 times as many views as the thumbs up button has been hit. So that means that a lot of you out there are watching the videos, which is great, but please remember to smash that like button, and it'll help with the YouTube algorithm. Thank you for watching, and I'm really happy that so many more people are getting on board with learning about financials, because it is unfair that we are not taught about it, and I'm glad that I can help so many of you, and I hope to continue and grow this channel as we go. And please remember to always stay positive, not just in your minds, but in your bank account, because it is a matter of life and debt.
Securities, subprime loans, tranches. It's pretty confusing, right? Does it make you feel bored or stupid? Well, it's supposed to. Wall Street loves to use confusing terms to make you think only they can do what they do. Or even better, for you just to leave them the fuck alone. So here's Margot Robbie in a bubble bath to explain.
Basically, Louis Rainieri's mortgage bonds were amazingly profitable for the big banks. They made billions and billions on their 2% fee they got for selling each of these bonds. But then they started running out of mortgages to put in them. After all, there are only so many homes and so many people with good enough jobs to buy them, right? So the banks started filling these bonds with riskier and riskier mortgages. Thank you, Banjo. That way, they can keep that profit machine churning, right? By the way, these risky mortgages are called subprime. So whenever you hear subprime, think shit. Our friend Michael Burry found out that these mortgage bonds that were supposedly 65% AAA were actually just mostly full of shit. So now he's going to short the bonds, which means to bet against. Got it? Okay. Now fuck off.